Welcome to RealAg Live, everybody. I'm Sean Haney, your host, also founder of RealAgriculture.com and host of RealAg Radio. You can hear every day on Rural Radio 147. Today's guest is JP Gervais. He is Chief Economist with Farm Credit Canada. Hey, JP, how's it going?
It's going super well. What about yourself?
Doing good, doing good. Looking forward to this. A lot of people have been retweeting and liking when we're notifying them of this your appearance here on RealAg Live. So I'm looking forward to it. Everybody out there, if you're watching on Facebook, Twitter, or YouTube, you can ask a question by entering it in the comment box or the space that's provided there, whatever you call it, and we'll get to as many as we possibly can. JP, right at the top, let's start from a kind of 100,000 foot level. COVID-19, very, very much, of course, we're in the middle of this pandemic. It's underway. Everybody talking about when are we going to reopen? That's kind of a very complex question. It's not exactly like we're reopening a golf course, so to speak. It could be a long process.
It could be. And what is super interesting is just how a few months in terms of reopening can have a big impact from an economic standpoint, right? So I don't pretend that I can speak to all the health issues and which are really important. I'm not discounting any of that, that's for sure. And I really feel for those that are out there and risking their health, for us to be fed and taken care of. And but just the simulations you can make, on the pace of economic recovery and just a few months, being confined for 2 months and then gradually reopening versus a longer confinement and the impacts of that, a few additional months on the overall economic rebound, because that's something that I'd like to speak with you, Sean, is just the idea of an economic recovery. There's going to be one, just don't know exactly when this is going to all happen, right? But just the pace at which we're looking at rebound, I think, is going to be really something to monitor going forward.
Yeah, and of course, we're in that period now where we're getting a little bit closer to what feels like kind of the other side of it. And I don't know which economist it was, but I saw on the CNBC ticker this morning, somebody had predicted that the recession could be like 10 times as bad as the Great Depression. We're at that point now, JP, where we're making some big, huge estimates. Yeah. I'm not an economist, but that seemed a bit of a stretch.
I think it is a little bit of a stretch in that case, but this is going to be significant, right? 2008-09 is sort of in my head anyway, this is how I compare what's going on right now, right? So we can go to the Great Depression, and of course that was a major shock for the entire world economy, but I do think that we can work with 2008 and 9 and understand, is it going to be worse or better? It looks like, frankly, a really high likelihood that this is going to be worse. And we're looking at, if you look at, and then there are dozens of forecasts out there, right? And so I'm not going to add my own, but if you work with the IMF, for example, that was released a couple of weeks ago, and then you look at a GDP decline of 6.2% in Canada for 2020 on an annual basis, that looks low right now. I mean, we're probably looking at close to double digit, if not, double digit and slightly more in terms of 2020 impact. And then, as I said, you need to, even the confinement of a couple of months is going to have an impact on what 2021 is going to look like, right? And that's hard for people to visualize. A couple of things. First, you work with percentages, right? So you go down 10, you need more than 10 to get back to where you were to begin with. So that's number one. Number two is, and then you do the math, and number two is, that it's hard to visualize how just a couple of more months, right? Let's just say we all stay confined for 2 more months. The impact of that additional 2 months in terms of rebound and how long that's going to take us to get back to where we were, that's a lot, right? It's more than 2 months. It could be, 10 months to 2 years. And so, and just because, right, lower income, a big sacrifice of a lot of the labor force, and hence, to read that they're going to have a hard time getting back to where they were prior to this entire confinement. So we're talking about some serious economic impacts for sure.
Well, earlier today I did an interview with David Coletto from Abacus Data, and one of the things that we chatted about is, even as you lift restrictions and people can go out back to a restaurant, because right now dairy, pork, beef, very, very impacted by the sense we've lost 50% of our business, or a portion of that 50% dramatically. And as those things open up and people can go back to a restaurant and have that big steak at the keg that they've missed so much, just because you can doesn't mean that they actually will. It may take a little bit longer to get people back into a regular routine.
Of course, and that's just related to, if you look at unemployment numbers, right? I mean, that's one statistic that says a lot about the household income. And so when we can actually go out and sit down at a restaurant and have a nice meal, there is going to be a significant segment of Canadians that will not be available to, or not be able to actually just spend as much as they would like. So I a number of issues going forward in terms of the rate, right? The longer we are confined, and for health reasons, which are really good reasons, I want to emphasize that. Well, the longer we are, the longer is going to be the recovery into 2021 and beyond, and that's
Yeah. So I guess JP, when you look at a demand, this all from a demand standpoint. What do you foresee here when you're from an agricultural perspective, right? We're looking at this and we're saying, okay, supply is not necessarily a problem. Farmers are going to raise livestock. We're going to grow crops, provided we can get some of the temporary foreign workers in some of the crops. A lot of concern in the specialty crops for sure. But for the rest of 2020, like say September on, do you, even if it is a longer U and not that V shape that some people are talking about, could there be some really good stories in the second half of 2020, or is it more a heightened level of concern from your standpoint?
well, it's a level of concern. High level, I'm not so sure, but it's a level of concern. Absolutely. You have to think about first the export sectors, right? So a lot of what we sell is exported. And so maybe good stories are on the export fronts. And some of the countries that are ahead of us, think China in terms of.
Oh, I think we lost him. Okay, well, we'll try to get JP back here. I apologize for that, everybody. Hold on here. I got to work fast. Just hold on. Don't leave. Reconnecting. Okay, just hold on, everybody. I wouldn't want to have to give this economic update. That would be a little bit scary. Okay, we'll try to get JP back here. Let's give him a shot. Here we go. We'll try to get him back here. Huh. Yes, rural internet, except he doesn't live in a rural area. So that's part of the problem. Okay, we'll try him back here in a second. So, yeah, I think part of what JP's talking about here is that there's a lot of economists, people talking about how this is going to be like a V shape. We're hearing this a lot out of the U.S. right now, that we're going to have this V shape recovery. That once people can really, really go back to being able to go out and buy stuff, or go to that restaurant, or go to that Home Depot, or whatever it is, as we lift these social distancing or shelter-in-place restrictions. I think one of the things is that it's maybe going to be a little bit slower than some people anticipate, and more of a long U, so to speak, as opposed to that V shape. And that's kind of what JP has been saying. Let's try him again here. I think we got JP back.
Don't know exactly what went on, that's for sure.
We got you back, JP.
Testing went really well, and then as soon as we went live, Sean, it just fell apart.
Well, we got you here. So, okay, your picture will come back on. It's okay. Okay, JP, question here from, we got Gonzalo watching from Uruguay. Hey, Gonzalo, how's it going? Let's get to John Weeb Dykstra. He farms in the Maritimes. His question is, what is your expectation for how long it will take to increase interest rates? We're in a very low interest rate environment. What's your timeline for higher rates? What do you think about that?
Oh, we don't have it. I'll be frank. I mean, we don't have a timeline right now for higher interest rates, right? The one thing that we keep monitoring is how low average borrowing costs. So we know about the action of the Bank of Canada, getting the interest rate or the target for the overnight rate as low as possible, given that they established that they're not going to go lower than that. So that's one thing. And then, we're monitoring how fast and how low all the other interest rates are going to get, right? And so in a span of, I would say, maybe 4 weeks, we've seen long-term interest rates fall by about 0.7%. So there's nothing that says that, long-term interest rates are going to match what the Bank of Canada is done. So that's one thing. So even if the Bank of Canada, and we've seen this in 2017 actually, even if the Bank of Canada would be in a mode of raising interest rates slowly but surely, or whatever the story is, I'm not even sure that we would see long-term interest rates starting to climb. So in this moment, I don't have a scenario in which interest rates are going to start going back up. And that's tied to some of the discussion that we had early on with regards to just the fact that the recovery is going to extend into 2021 and beyond. And so I really want to emphasize that and beyond. It could take a number of years before we get back to growing again at the pace that we saw prior to this recession. So I don't have a timeline for higher interest rates, frankly.
Well, yeah, and you look at some of those 30-year bond yields, man, they are not very enticing to put your money in there. That is absolutely for sure. Think about employment as an example, right? We've seen tremendous job losses in both Canada and the U.S. There's been a lot of stimulus, but I think, depending on what industry you're in, and majority of them, they're going to be somewhat cautious to just all of a sudden, hey, let's invest and make sure we're expanding our workforce here to tackle what could be in front of us here in the latter half of 2020. I think businesses will be a little bit cautious on hiring, which is not good for employment.
No, and the businesses have to deal with a number of different issues, right? Absenteeism, people not showing up for work and considering all the different conditions that exist in processing plants, and processors have made some great adjustments and some really big efforts into protecting the health of their workers. But despite that, they face some really difficult issues in protecting their labor force and establishing and maintaining production, the pace of production. As we well know in red meats, but I think it's also to some extent, it applies to all those different sectors as well. So businesses are going to be cautious before bringing in more or employing more or rehiring and so forth. And then those businesses that have a steady demand, steady as you can have in the current environment, that's shifting a whole lot, that makes forecasting nearly impossible, right? Just to think of the short-term shift that your business can actually have to deal with just based off food service versus retail. That's, people don't really understand how difficult this is to shift from one customer to a different type of customer, being from food service to retail. Just the packaging, the size, and all of these different things are totally different from a food processing standpoint. And so businesses in general are going to be they're going to be cautious going forward, I would suspect, for sure.
Yeah. Okay, so let's think about things a little bit more domestically here. Recently, FCC put out its land value report for 2019. We saw another increase at a lower. We're having increases at a decelerating rate. Is that the best way to put it?
Yeah.
Any comments on that report?
Well, it seems like weeks and months ago, but that was really early April that we reported on 2019 values. That's one of the questions that we got a whole lot from, or many times over the last couple of weeks is what would be the impact of, the COVID-19 crisis on land values. And that is not a surprise to me. Farm businesses that's their equity, and that's where the assets are in agriculture, and of course, a lot of businesses are thinking about that when thinking about the strength of the balance sheet and how this is going to carry them, through this crisis. And so, at this time, even from a anecdotal standpoint, right, and looking at the transactions that we're seeing, we're not seeing necessarily a slowdown in a number of transactions, more caution in terms of bids that are being submitted, perhaps, and a little bit of I would say a slower pace. In terms of transactions, we're not seeing fewer transactions, maybe more of a slower pace, and that's totally understandable. And so, from that standpoint, I don't expect that the demand is going to be any weaker so that you would get an end result in which, if we talk maybe a year from now and look back at 2020, that we're going to see anything that would slow down in the farmland market. If we have a rate of increase 2-3% for 2020, frankly, I think that would be healthy,
Yeah.
not to go back to some of the rates that we had in previous years, and still very healthy, to grow at a rate of 2-3% in the current environment. So I just don't see the land market being exposed to some significant downside risks. Of course, as we go into 2020, we're talking about when we were cut off, the farm income, the outlook for farm income, and where are the opportunities. And so, of course, at one point, we'd like to see some opportunities materialize and see farm income grow. And if that's not the case, perhaps this has a little bit more of an impact towards the end of the year, but in the farmland market. But overall, I think it's going to hold steady.
Yeah, I wrote a piece it would be back in early March when we started seeing the significant cuts to interest rates. I just think with rates so low, it's just not conducive to a big drop in land values. Now, in certain regions, maybe, depending on how the year goes for people that are in special crops, not being able to get labor, there could be some bad profitability there. Or if you look at the livestock sector, where I am in southern Alberta, there could be some concerns. But overall, from a national perspective, I agree with you that I think we're going to see an increase in 2020 again.
We could, and interest rates are, I've been talking about that. You were right on in terms of interest rates, and we did discuss following a question that we got that, there's just no perspective or likelihood to see higher interest rates, and that should be supportive of current land values.
You concerned at all about farm profitability this year at this point?
Of course, that's definitely a concern, right? So, if you look at red meats, it's not only the current level of prices and the current issues, when it comes to getting the animals through the plants and so forth. But it's also looking at what futures are telling us in terms of profitability into the fall and later in the year. And then right now, it's one thing to say, well, every, operation should have a good risk management strategy in place and so forth. But right now, it's really difficult to lock in a profit, throughout the year. And, if you look at grains and oilseeds, if you use the new data from the production guides that have been updated by the different provinces and so forth, with those costs going up, we're going to have a good year from a production standpoint to make sure that we break even on a per acre basis for a lot of the different crops. And so profitability, maybe on the grains and oilseed side, although lately I would say in the last 10 days, it's been not as good as what we had seen at the outset of the crisis, where markets all held up pretty good, maybe aside from corn. But yeah, in terms of profitability, that's for sure a challenge. I think 2020 is going to be challenging, and it's not a strategy to hope for a good year from a production standpoint and yields, but gosh, it would make a whole lot of difference if we could, just put those last 3 years, depending on where you are in the country, I guess you have different consecutive years of production challenges. But if we could get those years behind us and look at some good years, that would help tremendously, I would say.
Remember not too long ago, JP, when the railways were our biggest problem?
Yeah, it seems like so far back. It's just, yeah, absolutely.
And they've had some banner performance. Like March was a fantastic month for both CP and CN, so that's great to see that that has been the case. Okay, so from a profitability standpoint, though, a lot of that will be dependent, I think, on the life preserver of the Canadian dollar, especially in the livestock sector. We've seen tremendous pullback in the futures market as well as, of course, cash prices. But the Canadian dollar going lower could be that life preserver, at least get us a little bit closer back to even in hogs and in beef. What are you thinking right now for the Canadian dollar?
Well, if you'd ask me, what would be the number one surprise, the number one thing that I would have expected to behave a little bit differently would have been the loonie. I would have said, I would have expected to be under 70 cents right now. And it seems it did go there for a while there, right? So, leaving, we started the year at 77 cents. It went to 69. I even think it went to 68. Not so sure anymore, but maybe it didn't close there. But I think it did touch on 68 at one point. And then now it seems that 70 is a pretty solid floor that I'm not sure that we're going to be able to break. But given where oil is, given some of the interest rate outlook, and given also all the uncertainty in the world economy, maybe if we see a little bit of the stock market pull back, and maybe investors seeking a little bit more of the U.S. dollar, maybe that's what's going to take to weaken the Canadian dollar a little bit more. But going from 77 to where we are now, I haven't looked today actually where we are, but to me, I would have expected to be a little bit lower, given frankly what sort of the outlook that we have in front of us in terms of economic growth.
I'm with you. I agree. So I'll ask you this question: are we more likely to hit 75 or 65 first?
I would say 65 first.
Yeah.
Yep. I don't think that we'll go to 65, but if you put me in front of those two options and pick one, I would say. But again, it seems investors have been underestimating the spread and the magnitude of the losses that we've had and the economic stress. They haven't seen it, they didn't see it coming as fast as maybe, we would have expected in hindsight. But then right now, markets behaving as if we're on this path to recovery, but we have yet to actually get out and actually have confirmation that, it's secure, it's safe to actually go out and resume some pace of normal activities and so forth. And so I got a lot more question marks, for the next couple of months than answers. And so to me, that speaks to uncertainty, that speaks to a high US dollar, and so a lower. Hey, never bet against the market. That's one thing that I've learned over the years.
Honestly, I was thinking the exact same thing yesterday. I was watching Fox Business, and they were talking about how, the equities are performing so well. And I just sat there and sort of thought, why? Like, is it because that we think the recovery is going to be really, really quick? Or is the market thinking that we overshot the downside in terms of the push down? And I'm not sure. We don't really know what the answer is, but I don't know. I'm kind of with you. You look at the airline sector, for example. What would give somebody any encouragement besides maybe Boeing gets completely bailed out? What country's ordering airplanes in the near future? Like I'm surprised that some of those stocks are not lower in sort of my thought.
I never, ever speak about the stock market. And I broke that rule once recently on my Twitter account. I read a wonderful article. It was just basically comparing different sectors of the economy, the different recessions that we went through and how the stock market behaved. And I had to tweet it, and I had to just say, hey, this is a wonderful article. Anybody's interested, get some of your insights into how long this is going to take for the stock market to rebound based off some of the past experiences. It could be relatively short, but it could also extend a long time and so forth. And depending on the sectors, as you mentioned, travel and so forth. I never had so much interaction on social media than I had with that particular tweet, which is kind of interesting. And so I thought, well, maybe I should actually switch fields here and then go to finance. But just to speak to, like, it has behaved, the financial markets have behaved unlike what you could have expected looking back at history. And so I guess it makes sense in one way, right, that we've had a recession and we've had an economic shock that has been like no other, really. And so I guess it makes sense then for the stock market to behave the way that it does. But it's one of the fields where I normally don't go because I'm a very, very limited resource when it comes to the financial advice.
Hey, JP, I got a question here from Cole, and I think this is a question that is typical of what is going through the minds of producers right now. It is FCC and a lot of farm business coaches encourage farmers to have a strategic plan, an operational plan, and work through the numbers and really think about things strategically. And people, more and more farmers are doing that. And the reality is when you look at a SWOT analysis of any business, any farm, nobody had pandemic in the threats. There's just no way. So Cole asked this question, and I think you can speak it in terms of generalities, but Hi, our family has planned to build a feedlot this year to supplement our cow-calf operation. At this point, we have a small amount invested in the project. With the current situation with the Packers, would you recommend a wait-and-see approach, postpone the project past 2020, or completely cancel it at this time? Thanks, we farm in Saskatchewan. I think a lot of people are kind of going through that kind of decision-making right now. It's kind of what do you think about the outlook?
Yeah, nobody saw. So I'm just going to pick up where you mentioned nobody saw the pandemic. Correct. Nobody saw it, right? But I mean, I've been saying, for a while now that, just, and whether you call it the pandemic or any type of other shock, there's always going to be shocks that we don't know about, right? Financial institutions do it. We do it at FCC. We call this a stress test where we're going to challenge ourselves. We're going to have this baseline forecast. We're going to have some uncertainty around these forecasts, especially now, given, you can't really rely on historicals to tell you what the future is going to look like, because right now it's an unprecedented situation. So you don't have anything in the past that would sort of correlate with what's going on right now, right? So forecasts are not necessarily useful. Then, you build some uncertainty around these forecasts and you say, well, really, how do I know that even that is, necessarily something that's potentially reflective of the reality? So what do? You stress test. You challenge yourself to think, right, what's the worst case, right? Let's think about something that cannot happen, and then let's just see how it plays out in our balance sheet, right? If you're a financial institution. And I would say, let's do the same thing for farm, at the farm level as well. Let's challenge ourselves not to just play around with cattle prices and drop them by 5-10%, but let's just stress test to say, all right, what if you get to that point? Whatever, you don't have to build a story of how you get to that point, whether it's a pandemic that's going to bring this scenario, or whether it's going to be whatever else, sorry. You just challenge yourself to stress test and really build a scenario that looks at sort of the worst case scenario. And in that sense, that gives you an idea of those very big strategic pieces, right? So maybe you'll find out that, I thought I had enough capital to go forward in that scenario, but I don't. And not only that, but maybe that sort of puts my lifestyle in jeopardy, that puts whatever else in jeopardy as well. And so that those are the things that I believe that are the most useful, is to really challenge yourselves to get out of using a price. When you look at strategic plans, right? It's one thing to have a business plan and say, right, this is how my feedlot's going to work. This is what I'm expecting in terms of revenues. Those are my expenses. This would be my profit. And maybe you can challenge those assumptions up and down and have a little bit of, build yourself some flexibility and some room to flex if prices turn the way that you don't want them to turn. But from a strategic standpoint, look at different points in time 5 years from now and assume some worst case scenario, assume some positive outcomes as well that would just feed your thought process as to a big decision like this, should I go forward or not, right? And so I think that's what we need to challenge ourselves. Having said that, people have been asking me, and I know that's not necessarily the essence of the question, but people have been asking me about FCC's response to the crisis, right? And of course, first thing is, managing cash flows and making sure that, we helping out on cash flows. And one of the reasons we do that is because we still think, that long-term, the viability of Canadian ag, and look at all the different sectors, no matter what, is very positive, right? So the long-term viability is still there. It's to get through that and get to that other side of the mountain where things are going to look different and look better, right? So we do believe that the viability is there long term. Nobody knows exactly how the short term is going to play out, but that's what I would suggest, is that long term viability is there, but I don't want to downplay the disruptions right now. I mean, there's a lot of different questions, whether it's in the cattle sector, whether it's in the special crops, or in terms of what kind of outlook for profitability, beyond the next few months and even into the next year.
Yeah, honestly, every operation's different, right? So it's asking yourself the question, okay, if we stay in this current environment, is that a smart investment, right? Or, am I better off to maybe put it off and say, keep some of my powder dry, so to speak? I know I had Dr. Jim Mintert from Purdue University on RealAg Radio recently, and he talked about how, for a lot of the farm operations that are really, really close to the edge, some of these, this is sort of like that last step. Some of these problems were here pre-COVID. They're just now being really accentuated, or however you want to put that, under this sort of scenario. And it gets back to a comment that was left by Brian Voth here in the chat. He said, not a question, but I fear in the management decisions the last 5-ish years are about to bite some farms in the coming year or two, unfortunately. And probably that has to do with lack of working capital for some people.
Oh, for sure. And working capital is, and cash flows, and that's liquidity is primary concern right now, for sure. I mean, we look at what we heard from our customers, and that's been a challenge in a lot of different sectors across the board, right? I mean, whether it's part-time farming and it's off-farm income and the impact of the oil price shock and so forth. I mean, there's a long list of different factors they're gonna have an impact, but long-term viability is still there. It's just we got to get through this, right? Just like you and I have talked about this in the past of flattening the economic curve, right? Making sure that you minimize structural change or structural disruptions, right? So we know that there's going to be some economic costs short term. There's going to be some short term stress. We're already in this. It's how fast are we going to get out of it? And once we get out of it, what kind of structural change are we looking at, right? And so you want to minimize that. And hence the reason why the rationale to have a strategy and a policy to support businesses, support families and so forth, to prevent businesses to have to make decisions that are not in their best interest long term. And of course, you won't be able to say 100% of businesses are not going to be able are going to get through this crisis, and they're going to, of course not. I mean, if one thing we learned in past recessions is that there's some significant long-term impacts following a recession, right? But you want to minimize that structural change. And I think it's important from an ag and food standpoint that we minimize that structural change, that negative structural change that could happen, preserve capacity for us to feed the world, feed Canadians. And that's not going to be easy. I'm not saying, hey, I know this is going to get tough to get through for some operations. Not all operations are like, as you said, but hopefully everybody can do their part to get through this and then be on the other side of that and in a good spot, with positive viability going forward. I have very much confidence that that's going to be the case, but that's going to be tough to get through for sure.
Absolutely. Comment here from Lindsay Smith, who is Ontario Field Editor for RealAgriculture.com. She says, hey, good advice on the stress test for sure. When writing business plans and running projections, it's so easy to always see the best case scenario. That was good stuff. Hey, JP, we're out of time here. I want to wrap up with this. Going forward here in the next couple months, what are some of the things what are the indicators that you're following really closely to tell us how quickly this economy, is it on the rebound or is it stalled? What are the things you're watching?
Employment, number one. I mean, I want Canadians, as you said, right? It's one thing to ease confinement measures, but I want Canadians to have enough money to spend. Employment is going to be key. Second is going to be the oil market, right? It's 7.5% of our economy. And then there's a ripple effects. And of course, in the prairies, it's more important and more significant than anywhere else. But there's some ripple effects. So employment is one, energy sector is the second for us. And I would leave it at that, and if we see the Canadian dollar go up, I'm hoping that this is going to be a sign that we're on path to recovery.
Agriculture's moving up the food chain, JP. Forestry, not doing too good. Home starts aren't going to be super fast. Energy not doing well, of course. Tourism is going to be a long recovery. Yep. Eggs moving up the totem pole, so to speak, when you think about it.
Yeah, and if we can get, and it's going to be a challenge to on the food processing side of things, because the cost structure has been going up for food processors and producers are at the farm level. There's some significant profitability challenges as well. But if we can get through this, like I said, this is long-term viability at the end of this.
JP, you and your team do a great job of putting out economic reports and on your FCC economics blog. Is it just on the FCC website, best way to find it?
Absolutely. fcc.ca/knowledge. You should get to our economic section.
Awesome stuff. Hey, JP, this has been a lot of fun. I know you and I could geek out on this for a couple hours, but we will spare the audience that. Hey,
It's always a pleasure, though.
JP, really appreciate it. Thanks a lot, bud.
You bet. Thanks so much, Sean.